Happy Tuesday, everybody. Coming at you live from downtown Columbus. Stratton Mortgage here, Season 1, Episode 13. We've stepped up our podcast game here. We'll start off with the introductions. I'm Tom Christie.
Bill Seach.
Adam Baumline.
So we have some really good topics today. Again, trying to keep everybody informed. It's extremely hot market here in Columbus, Ohio right now.
Number one market.
Yeah, just recently rated HousingWire.com of all the cities. Again, we're talking West Coast, East Coast. One article has Columbus rated the number one hottest market in the United States. Just goes to show how much growth is taking place, and anybody's lived here for all the years that they have, like we have, it's very evident of what's going on. Just traffic alone will tell us that. So, Bill, I know you had a great topic you wanted to start off with.
Yeah.
So I think we should get rolling with that one.
The topic of the Fannie Mae underwriting engine went from 10.2 to 10.3, and it's making it a little tougher to get things approved and stuff like that. I had a higher score gentleman that I thought would be a simple laydown, approval, and then I really had to get his ratio to come down from the normal 50 to 39 before it would approve it. Now, again, that's close to maybe limited credit or something like that, but
but it's making a difference, though.
It's making a difference. It really is.
There's
And
like 2 months ago, that would have been like, just look at it and this is going to get approved. Like that, we were doing that, and they were. You
wouldn't have to restructure it; it just would have went and closed. Yeah.
Right, and also, something like that, like a broker is going to take it, and like I did, I kind of worked it down. I started at the ratio at 44, 45, 43, and just went down until I hit an approve, and then he'll have to pay something off. That's all to make it work. But
you had a solution to make it work.
Right.
Yeah.
But I messed with it for a long time, whereas a guy that's doing 50 loans a month isn't going to be able to do that.
Exactly.
Yeah,
they're going to pass it off to another person to work on it. They're going to come back, say they can't get it done, and sorry, we can't make this work out. And now they're feeling like, now you have nothing to go off of, and been told no here, when in fact it's not a no. It's just somebody didn't take the time to figure it out.
Well, and if it's really close to, okay, so we have lower rates and lower fees. So if depending on who they're going with, that could make a difference between not qualifying and qualifying.
Oh, absolutely.
You know what I mean? It can make a huge difference in that regard. So, it's definitely affecting.
To further your expound, we just had a loan that closed. Actually, we had a closing on Saturday. That instance came up to us. We discussed this in the last podcast a couple weeks ago about telling us everything, because it all needs to come out. And if it doesn't get told up front, it will eventually come out some way, shape, or form. But there were some unknown about payments that came up during the loan process, trying to run a conventional. These clients were conventional borrowers, and before that change, it would have ran approved eligible. Yeah. But because of that change, and changed the debt ratio, now all of a sudden it could not get approved eligible, and then, again, the luxury of being a broker, and even the realtors acknowledged this, that we were able to give it a valuable resolution, change the loan over, and still get it closed, and meet everybody's dreams in a domino effect. But again, because
that was like a buy, sell.
Yeah, what are some examples of what came up? What were the examples of that?
So we had somebody that was self-employed that had IRS payments and child support payments that on a W-2 borrower, if somebody forgets to tell you these things, those things show up on a paycheck stub. So we can catch them there, but.
It wasn't on the bank statement, the one that we got, and then it showed up.
Yeah, and when they're self-employed, so we don't get W-2s. We don't get any kind of paycheck stubs. So we're relying on that client to really divulge us information so we know how to go and put the loan together. So, and to Adam's point, it was, they updated bank statements, and they found a recurring payment on there, and that's when the question was arising that, well, what are these? They now have to be in. And, we don't know. We have to find out. So again,
and they needed that bank statement because that had to show their assets, because that's what proved they had the money for closing. So
exactly,
it literally was something to where that customer was getting. So sometimes you have a situation where the customer, maybe they're getting a bonus, or if they're self-employed, they know there's a check coming in and they need that money for closing. Well, we still have to proceed with the loan ahead of time because they have 30 days to close, and then we're waiting for that to come in. So in this case, that comes in. Okay, great. Let's get your updated statement. Whoa.
Yeah,
we got a hurdle to jump over here.
It was honestly a mistake on their part. They just didn't think it was something that had to be told. And again, it was nobody's fault. It wasn't their fault. But at the same time, we were all able to come to a resolution and get the loan figured out for them. And that, again, back to, people can Google why, hashtag brokers are better. There's a long list of reasons why, not just cost and rates alone being lower, but the flexibility that we have of being able to take that opportunity. Like, had they been at a regular bank, that this wasn't going to happen. This loan would not have closed. And again, I was even told as much. If they were anywhere else, and somebody who maybe just didn't have as much hands-on as what we do with these loans, the sellers would have not gotten their home. The people they were buying their house from, they wouldn't have been able to sell their house. I mean, there was about 4 families involved with this that would have all been completely just crushed. And that gives our industry as a whole a black eye, and because it's all kind of gets lumped together. So, again, I'm doing a loan right now for a lady we took from Fairway Lending that, the guy neglected to tell her about his loan program. I had to give her information about how that loan program worked, and she calls him back like, "Oh, well, yeah, I guess I forgot to mention that to you." And it's like, what? Why do the mind games? Everybody's trying to sell you on why you need to do business with them. Then once your foot gets in the door, you're nothing to the cog in their system.
Right.
And then they just kind of go through due diligence, throw it against the wall, and hope it sticks. And this is the biggest investment. And she was so uninformed after a week of working with them, on the phone with us for 30 minutes, and she just had an aha moment, and it all kind of came together. So it's, again, we are brokers, but at the same time, there's a reason why we've been doing this as long as we have. We just know how to adapt and roll with these changes. And this 10.3 to 10.2, or from 10.2 to 10.3 rather, is a big deal.
Right.
And taking the time to figure it out is huge.
Well, it's a very big deal because there's a segment of borrowers that, so especially in our market, more than likely they want to see a conventional offer over a FHA offer, right?
Yeah.
So you've got a group of people that, are really on the borderline. They can go either way. FHA is probably better for them because it's a lower payment, but they want to get in the home, so they'll take the conventional loan, whatever. Well, now that group is being squeezed out of conventional a little bit, and now they're in FHA. So, it can make a difference if they haven't found a home yet, because the market's tight. So maybe they haven't won an offer yet because this just happened, a couple weeks ago, or maybe it's a month ago now. But, they haven't won an offer yet, so they don't even know what's going to happen until they're going to go into underwriting and be like, hey, you don't qualify for a conventional loan. So it's going to be a problem.
That's a great point. I didn't even think about that. Is like the people who did start that pre-approval process maybe in March, and they were looking at this saying like, oh yeah, then because when they're putting these together, they're looking at it and saying, yeah, I know I can get this thing clear to close. Now, once it goes in contract, they go try to run that. If those debt ratios, and everybody's doing it, they're pushing their debt ratios up on these people, and then it's going to fall back on the customer. Well, here's why we can't do this because of this, because of that. And if those things haven't been rechecked, you might want to get with somebody and have it rechecked just to be sure that you're not throwing an offer out there on something that you can't close, especially if you're potentially selling a home and then you're going to be relying on this thing has to sell in order to buy this house. That domino effect, then it becomes very, very interesting when things start getting hairy.
Well, that, or even if you're a first-time buyer, let's say you're buying a home, and so that seller is selling, and then they're buying a home, and then that seller is selling, and then they're buying a home. So you literally, that can affect three, buyer-wise or seller-wise, like 3 families, plus the agents, plus the title companies. I mean, you're affecting like a lot of people if that goes in, and some things haven't happened, and some of that's outside of someone's control, but that doesn't make it any easier. That doesn't mean people are still going to be upset, and you got to watch out for that.
Yeah, and again, just again, as a buyer, always, again, something we say every episode: ask questions, be inquisitive, know more about this investment that you're making, and that the people that are handling it are dealing with it the way that you're expecting it, and you're hoping that it should be handled. Because it may sound good up front, but what's happening behind the scenes might not be what all you heard up front. Again, I did just experience that with the client, and she was able to ask those questions, and I gave her questions to ask, and once she saw the math, she made the decision herself. Yep, this process or this program is actually better than the one they were offering, and they neglected to even show her the conventional side of things. They went straight to a one loan program that I can't even offer, and I knew more about that loan program than they did. That was alarming to me, that alone. But again, that's another story for another day.
And that goes back to, they have 50 loans on their desk when, I work on 5 or 6 a month.
Well, no, sometimes they're pushing really hard for no down payment and grant money and free money, and there are people that need that and it's there for a reason, but it a lot of times gets overserved and something. There are a lot of trade-offs to get that. That money's not free.
Yeah.
You know what I mean?
Right.
There are second liens, there are higher interest rates, there are higher fees that are associated with a lot of those programs.
It's a higher payment.
Some of which we even, there's programs we have like that too. So we have things like that, but sometimes it's not always in the borrower's best interest. If you really look down and look at the alternatives, to not doing that.
Right.
Can't say all the time, but I would say a lot of the time it's better not to do it.
Yeah.
You know what I mean? That it's just really not there. But they're pushing that because they're trying to get people in the door, and whatever. And
it is
what it is.
Yeah, it's an easier clickbait, and that's kind of one of the ways to push. I mean, how many of us they're scrolling through your Facebook or scrolling through your internet, like, there's something that grabs your attention that requires you to click on. You're like, well, this is what I thought it would be. But you're able to make heads and tails of maybe a news story or something. But when it comes to a mortgage, you maybe don't. And that's that's what separates us. And I know without a doubt from probably 90% plus of the people out there is the way we handle and explain things to people, that they have a much better understanding. And again, people go back and look at our Facebook page and Google reviews, and what we're saying is all out there from the public, telling you what we do and how we handle this, again, large investment that you're making.
You just got to get one the other day.
What's that?
You just got to get one the other day. Good review.
Yeah, that was a client that, again, I just taking those extra steps. Again, another client, she was seeing insurance premiums like $1,500-$1,600 a year, and most other people are just they're just going through their daily due diligence. They're going to, this is your insurance, okay, great. Well, that affects your payment just as much as an interest rate does.
Sure.
So I ended up finding them homeowners insurance for $600 less a year. That's a tremendous difference in monthly payment. And again, had she been with somebody else, they wouldn't have even thought twice. They'd just grab that homeowner's insurance. They don't want to waste their time.
Right.
It is what it is. Here, we'll just get our mortgagee on there. We took the time, gave her some people to go and look at that might give her a better deal, and I was able to save her $600 a year, and which also helped decrease her payment.
$50 a month.
Again, those little things go a long way.
But that insurance is different. If somebody was comparing Tom with somebody else, and the other lender was $20 less, well, your payment's lower. Okay, well, you have to look at the insurance. Like, use a bill $50. You're like, that
makes a difference in payment.
They're tripping over other things that are less amount of money per month than that. Yeah. So, and that makes a difference to what you see. You got to look at the whole picture.
That's the difference between 39.5% debt ratio or 38.5% debt ratio.
It
right?
can be.
Exactly. Right.
Absolutely.
So.
And not to mention cash to close. By doing that was $600 less at cash to close for her as well, because on a mortgage transaction, that insurance is paid for up front. Of all the things, that's the one thing that is paid up front. So
a year, year.
For that year, and then being escrows as part of your payment monthly. Not only did it lower her monthly payment, but also decreased her cash to close significantly. So again, like it's, it just if you haven't, given us a call, or you should at least, give us a call and take a look at the math. It's numbers, and again, we talk to her blue in the face, but when you see the math, it all makes sense. I'm doing 3 loans right now that I have zero lender cost. We're actually giving the clients money to actually go towards their homeowners insurance,
closing
for
costs and
instance,
title,
the title, the escrows, and again, as a lender, as a person helping obtain the finance for this. Zero cost. I can't even stress that enough. And we're giving money back. So, I mean, again, it's cash to close is a big difference. If you're putting X amount down, then you had the title and insurance in there, that's just additional cost. So to decrease that, and that's what we're here to do. It's just a far more affordable process when you look at the math.
If you are trying to get a loan anywhere, you should talk to at least one of us just to see, you know what I mean? You don't have to deal with us, but you have to check, right?
And I try to think about it here in this aspect. So, what somebody makes per hour, and everybody, that's out there that might be listening, what you make per hour, what you make per week, and to take and convert that into, well, what is 5 minutes to potentially save thousands of dollars? What is that? How many hours of work did that save you? Looking at it in that regard. So, I mean, if your boss came and said, I'm going to give you 2 weeks of free vacation, you'd be like, yeah, I don't think so. Like, let me see, what does this entail? It's just 2 free weeks. Like, you take it or leave it. And who out there would say, no, you're taking those 2 free weeks of paid vacation. And again, it's just try to put an analogy together where people can really kind of understand and put it together. That's this is a lot of money that is left in your hands. And again, you already work hard for it. So let us help you show ways to decrease that cost to obtain that American dream and own a home here in Columbus.
Right. So just talk a little bit, to switch gears on you. I want to talk a little bit about a deal I just dealt with the bidding on the house thing. I know we talked about that last time, but this house was listed at $259 in Hilliard, and all these bids came coming in because it's in a pretty good location and everything. And my customer actually won the bid at $275, but the way they had to offer it, they had to offer $1,000 over the highest bid, up to $275. So they get it, right? And the very next day, we have an inspector go out and look at it. Well, now there's problems with the roof and everything else, and the fascia boards, and there's a crack in the foundation, all kinds of other things.
One.
Yeah. So all these issues come up, and the seller knew about these issues. Obviously, they got nails in the top of the A-frame up there, and so they lower the price to $270 now automatically, and now they're going to pay $2,500 in closing costs. So $7,700 difference, $7,500 difference. But that's the whole bidding thing where we talked about last week. You can bid whatever you want, but guess what? If the house isn't worth that,
it still has to appraise. And
well, that plus the problems, right?
Yeah, I mean, that house could have gold-plated toilets in it, and it doesn't matter. It's what everything around that is selling for. And I mean, somebody could have put an offer for $500,000 on that. Like, whoa, that's a great bid. Let's go ahead and go with that one. Well, if it appraises out at $250, who's paying another $250,000 negative equity? I mean,
I just closed one where it did in Hilliard.
Yeah.
I think the list price was $260 or $259 or $258. Something like that, maybe a little less than that. But my buyers had offered $267. They offered to pay $5,000 over appraisal, and they were going to pay I think it was $1,000 over, the verified offer or whatever. So I got in contract for $267. I actually appraised for $260. So I reached out to the agents and said, hey, I just want to make sure this is valid. It's one of the things we do just to check. And actually, the buyer's agent and the listing agent said, yeah. I think the listing agent lived in the neighborhood, said that's actually the highest, pretty much the highest sale in here, the highest comp. We were pretty sure it wasn't gonna go over 260. And what was nice was in this market, something I didn't think about in this market was I was talking to buyers about it. So they actually got $20,000 more or $25,000 more out of the sale of their property than what they thought they were going to get. Mm-hmm. So they took a little bit of that. They took $5,000 of the 25 and rolled in, and we moved the price down to $265. But so they paid the $5,000 over, but they actually got that money plus more than what they thought from the sale of their home.
Yeah, nice. Yeah.
So sometimes there's ways to work it out. But
and just because somebody overpays on equity, it's again, it's one thing to be spending $250,000 over. That's obviously egregious. But in Adam's case, like $5,000 over. But it's not necessarily negative equity, because now the next person that buys in the neighborhood, that's a comp. So the next house that goes on the market gets and sells for 200. Let's say that list price on that one is $267, and well, now the appraisal comes in on this at $265, and that's all because of that comp. So now that house sells at $265. Now all of a sudden you're not upside down anymore.
And they were already planning. So in their case, the money that they got from the sale, they said, okay, like we were sitting at closing, they're like, we're going to do this, we're going to do this. I told them about the new doors I got, and they were like, where'd you get those at? Because like we need to get new doors too. So they had already had plans to do some upgrades. Yeah. In reality, it's going to be worth $260. You know what I mean? Like by the time they do what they're going to do.
It's May. By the time we get to June, July, and those houses in there start going for upper 260, 270. Now they got in at the right time before. Again, I think had they gone in the back end of summer, we can look at the history and just go backwards and look at 2016 sales and 2017 compared to where they're at today.
Especially in Hilliard.
It's going up everywhere. And that's the people that sit on the fence, like, I'm going to wait for the housing market to cool down. Like, that's like looking at Google. Say, I'm going to wait for a pullback on Google. Like, when do you see it happening?
And you can correlate that. So you can tie that into, okay, I've got 5% down right now. So in the case of my buyers, they were going to put 10% down. Mm-hmm. Appraisal comes in low. He's like, or lower than the purchase price, what the actual value is, and we're talking. He's like, man, I'd like to have that extra money. I'm doing some rehab on the home, and I ran some numbers for him. literally it was less than $20 a month difference for him to put 7% down versus 10. And I was like, listen, man, it's not even, it's like $18.
Right.
Yeah.
It's not even a big difference. And he was like, well, yeah, I would rather do that. So if somebody's waiting, right, because you don't have 10% down, the rates are still very good. And there's a minimal adjustment between, it's 25, 15, 5% down. And the mortgage insurance, because the market is good right now, at least in our world, the mortgage insurance is really inexpensive. It's crazy how low it is.
To touch on that, I did a quote for a guy on a $470,000 purchase with 15% down, and they're nervous about mortgage insurance. On, again, $400,000 loan, okay?
Yeah.
The mortgage insurance was $35 a month.
Because some people know it is a percentage. So the higher the loan amount, the higher the premium. So that's a really, really low percentage.
Yeah, and again, you're exactly pointing out. Had that because it was a 0.11%. So we go down to you get that loan down to $200,000. That now we're talking about $20 mortgage insurance.
Yeah, it's
negligible difference. And to further on your case there, like that difference in payment to keep yourself liquid, interest rates are write off too. So, secondly, you can't find a credit card for $5,000 to $10,000 with a payment of $20 a month.
No.
Not only that, but it's also not a tax write-off to go get that credit card either, and those rates are really, really high.
Yep.
So you can, don't get credit card debt. Limit, keep yourself liquid with your, capital gain you get from another house, and then, just let the home appreciate itself, and because that's happening in Columbus right now. The house is going to do the work for you. You've made an investment, so. I show people all the time. They take this less money, throw in a money market account, make interest on it because you get the right to interest off anyways on this property, and you can't get this kind of difference in a payment with a credit card. So and it gives you have more freedom with your funds than you would had you tied everything up in that house.
That's literally what he was like. Yeah, I can't.
How you get it back?
I have no way to borrow that money for a payment. And I said, no, I completely understand where you're coming from. This is a viable option. And so, and we always talk about counseling and things like that. Part of that process before he closed, which, they still closed on time, but we had to go back and say, okay, let's redo the contract. Hey, we got to redo these numbers. We got to make sure and get your loan estimate out the right way. What do you want to do? And we still all did all that within the shorter contract time. But we do that. We do look over those numbers. We do provide those figures. Where we routinely get calls, from people that will say, hey, he didn't really this is what you qualify for, go do home. And now, in fact, that was the one I closed on Monday. She came to me, actually referred from a financial advisor, because the previous, actually 2 lenders, just weren't giving her any info and just weren't really helping her, and she's
just go through the motions.
She's a single person with, buying her first home.
Yeah.
She has nobody to rely on, and she doesn't know. You know what I mean? And took the time to help her and educate her. Got her a great deal, got her in the condo. She was super happy at closing. The sellers were really, really nice to her.
And she knows way more today than she did a month before ever even talking to you.
Yeah.
And not to mention, she's already talked to 2 other people, yet she still walked away with not having any information until she got in front of a broker and us.
Yeah.
And I think that one loan you were just talking about there kind of dovetailed into the one we were like everybody working together. And taking the time, and even as us, again, we always say there's more to this than here's a 30-year fixed rate mortgage for you. Like there's more to this than that, and this is the largest investment. It needs to be handled as such, but also working together with everybody involved in the transaction. When you keep in contact, communication is very huge in this, and what keeps the wheels greased and moving forward. So, taking the time, we call those listing agents. We're always talking to the buyer's agents, keeping them informed, just like we are the customer.
Mm-hmm. But sometimes it's not,
it's not easy.
Not the greatest conversations. Hey, this is what's going on. This is a hurdle that came up. It is what that. Unfortunately, in mortgage and real estate world, there are so many moving pieces that, as much preparation as we do, there are still times where something's going to come up that nobody could foresee, and people get upset about that, and they get heated and they get frustrated. The goal is to get to the end, figure out how to get through this, and we try and remain calm and help people through it and educate them as to what we're doing and show them and what's happening. So
viable solutions.
If you're an agent, you don't have to know everything about mortgage, but we're trying to say, hey, here's why this is happening. I understand. I'm not happy about it. I don't want to tell you about it. I understand you're not happy about it, but here's why. So So if you ever do run into this again, okay, you know what? Mm-hmm. This is what happened. At least, Yeah, it sucks, but at least I know what's going on.
Yeah.
And we're trying to give that education versus giving they're working on it. We didn't know there's nothing we could do. Which sometimes happens, and then they don't know, and then they get frustrated.
Yeah,
so.
and a lot of people out there are scared to maybe even address those. But again, everybody in this field, when a transaction starts, all have the same exact end goal.
Let's get it closed.
Yeah, and efficiently with the best deal that you possibly can get them, and when everybody works together, that process is a totally different process when everybody wants to start going at each other's throats. It just that's ridiculous. There's no need for it. I mean, there's probably some people out there who, to Adam's point, it's like, they're working on it. We'll get to it. Those, again, that's exactly the people we're trying to keep you from working with.
Right.
And those are the people who are going to hard sell up front, like, well, here's what we can do. We got this, we got that, and they're great in the beginning, but once you get to the loan process and maybe something does go sideways, good luck getting hold of that person.
Right.
Yeah.
And that's when you want that person the most, and then all of a sudden now rates aren't nearly as important to you, and this and that when they should have been, because they're probably more expensive to begin with. But
right.
At that time, now you wish you did have somebody in your corner, and whether it's good, bad, indifferent, we've always been there and always answered phone calls and always addressed whatever needs to be addressed. Because Adam's point, it's not every loan is a lay down easy. Let's get it done in 10 days.
You even closed one on Saturday, right?
Yeah. Saturday morning, 9 a.m. I was there. I showed up, and that's something else I find to be really alarming, that there's loan officers don't go to closings. Every time I go to a closing, everybody's like, "It's nice to see you here."
Right?
Like, is this not normal? Like, no. Like,
we go as much as we can.
Officer.
Yeah, right. We do. We go as much as we can. That's for sure. Can't go to all of them, unfortunately, but we try to.
Yeah, it's one of the best days of their lives right there. To close on the largest investment, and to be there and answer questions in case anything happens or comes up, and just support, if nothing else. Like, we're there from the beginning, and we're there from the day that you sign, and even after. I mean, right. How many times I still field calls? Hey, Tom, I got this thing in the mail. What is this? Oh, you don't need to pay attention to that. Or hey, what? I just got this. We're always here. You never buy a car.
Right.
So and we answer the phone and we call you back.
Sure. Well, moving forward to the next topic, and I think we're getting a little time constraints here, but I just want to reiterate, we're still in. I mean, we do a lot of purchase business, but there's still refis are starting to hit now too. I just closed 2 of them myself, and vacation season's right around. If you need some cash or something like that, want to rehab the house or add a room or whatever, give us a call and ask.
There's a lot of things that can be done right now, especially with the equity. Yeah,
and I'm doing 3 right now where I'm taking people from what is 29 years fixed today, being that they closed a year ago, down to a 25-year fixed. 2 of them, their payments are going down by $10-15. One of them, their payment, I think, stays exactly the same. Maybe goes up like $2, but they're wiping out 4 years, 48 mortgage payments.
That's awesome.
And essentially, essentially their payment stays the same.
You just reminded me of somebody I got to call.
But again, they back to us keeping track of these things, and for the nature for these people, they didn't know that. I was able to keep a track on the market, give them a call. Hey, by the way, there might be a chance, and the math either makes sense or it doesn't. And in these cases, it did make sense for them.
Sure.
And again, they're gonna, in 5 years, they will have had 9 years worth of payments in that house, while only making 5 years worth of payments.
Right.
And again, back to how many hours of work is that worth? What you just saved with it in that house. Now that's an annual salary right there, and then some when you calculate that principal and interest payment over the course of 48 months.
That's a lot of money.
That's tens of 20, 50s of thousands of dollars. And again, that's just when you see the math, that's what it all comes down to with its investments.
Right. I just did the calculator on my phone. That's about $70,000 on $1,500 a month. That's pretty good savings, Tom. Right?
And less interest that somebody would have paid to the bank. That's money you get to keep.
Right.
So again, it's amazing the number of people that just don't pay attention to it or want to listen to it even.
Yeah.
So the big question is, we're coming to everybody from downtown today. Where are we going to be next week?
That's right. Vote on our site.
Where we should we put a couple things on there?
Actually,
vote,
have a little contest.
Vote, see where people want to see us live.
Or no, they can guess. Now we pop it up and they win. Yeah.
We'll see. We'll figure out a new venue.
Sounds good. That's good for this week for me, guys. You guys have anything else?
I'm good.
No, I'm good. I think we had a good time today, so that was good. Bill.
Ask Stratton, reach out to us for questions, and
congratulations to all the graduates out there, including our own little helper over here, my son Bill.
Yeah, and, congratulations. It's man, think back, I'm getting old,
dude. 30,
I remember the graduation.
30 years from me, dude.
Yeah,
that's crazy.
I'm 25, 20. I don't even know.
Yeah,
it's a long time.
Oh, you're graduating. You're 18. How old are you?
38.
20 years.
20 years. Yeah.
I got you by 10 years, man. I usually beat him by 10 strokes in golf.
Yeah.
That's all right.
I'll drive my 60 yards.
Right.
All right. See everybody next week.
Take care.